We want to welcome you here today. My name is my name is Dennis Aniti, proud Binghamton alumni. Welcome, Jessica. We see you. Definitely excited to have you guys here today, especially in the midst of these market turmoils. But we wanted to talk about today. The main purpose is building wealth. Right? We all know we have to invest. So thankfully, we have Ryan and Ernest here to sort of guide us along the way in investing. I'll give my introduction. I am Dennis Aniti. I am a VP over at the Binghamton Alumni AOCN, led by our fearless leaders, Jen Gabriel, as well as Talon Peak. Ryan, I'll let you kick off with your introduction of your bio.
My name is Ryan Granville. I'm a proud Binghamton alumni also. I'm currently working as a director of grants in accounting, but I have a lot of background in investing as well as financial accounting. I started investing in the stock market at the age of 18 after interning at Standard & Poor's. So I've been in the game for 20 years, to be honest, and I look forward to share my experience with you guys and make it simplified so that you can understand how easy it is to start investing and start building wealth.
Yes, excellent. Ernest, why don't you kick us off as well? A little bit about yourself as well.
Sure. Hi, everyone. My name is Ernest Colon. I actually I'm a Binghamton University graduate, 2000, 2009, and 2011. I work as a certified public accountant right now in upstate New York for Piaker & Lyons. I'm also a certified financial planner. And I was a broker for many years, about 15, 16 years with some of the major banks in the area. So I have a lot of background, a lot of experience in working and dealing with individuals and helping them plan for retirement, plan for their short-term investment goals, and just making sure they understand their finances and are ready for the next step in their lives. Don't do a lot of direct investment advice now, but I do a lot of tax planning and financial planning with clients. And I think this is going to be a good evening for everyone to kind of just at least have a ground foundation to understand what they're doing.
Excellent. Well, Ernest, I think you can take control of the screen and kick us off with your presentation. Sure. Everybody, our presentations are going to be short, sweet, concise, but jam-packed. You will have questions. I will encourage you to hold your questions till the end. You can also send questions to me, raise your hand or put them in the Q&A. Yes, Jessica, thank you. Take notes, everybody, please. I myself am taking notes as well. Ernest?
Thank you. Give me a second to get this going. And I think we're good to go. Okay, hopefully everyone can see that. So this presentation is just about 10 minutes or less. And basically, I'm going to be talking about the basics of investing. And so just to give you an idea, this is not for an advanced investor. This is kind of giving you the foundation of what to think about, how to approach your goals in building wealth and financial independence. So one of the things most families are dealing with are two things. There is the debt cycle and the cash cycle. The debt cycle basically means your finances control you. Your cash cycle, you control your finances. The big differences are in the debt cycle, you're outspending your income. I've seen that quite a bit in my years. Borrowing to maintain a lifestyle, paying off one debt and accruing another. The one in the cash cycle, someone who controls their finances are debt-free, they're paying with cash instead of borrowing, and they're investing, they're saving, and they're looking towards the future. So what's the solution? One of the things we like to do is just get people started with the basics, understanding a foundation that will help them reach their goals. So one, learn how to invest. Pay yourself first, set up the 3 fundamental accounts. We'll talk about that in a second. 2, accelerate paying off any debt. If you do have debt, make sure you are not investing while paying high debt or any debt if you can do that. And then finally, protect your income. Your ability to earn an income is very important. And also, you never know if you're going to be in a situation where you could lose your income and be unable to reach your financial goals. So you want to be able to protect it. So we're going back and forth, but the solution again is these basic 3 steps is how you get started. Now, for some of you, you may be thinking, this is very, very basic, but we're going to talk about some asset allocation ideas, and we're going to open up to questions as well. And we can always go more in detail on what kind of strategies will help you reach your goals. But this is a foundational strategy to help you reach your goals in a way that helps someone who's starting out as a young professional to build up wealth. So one of the 3 fundamental accounts you want to build up is your emergency account. This is pretty basic. This is just money for your emergencies, uncovered medical expenses, major car repairs. Second would be your short-term account. Up to 6 months of expenses should be in this account, reserved for unforeseen events, a loss of job, a down payment on your first house. And then finally, the major goal would be, once you fill those 2 first buckets, is to build your wealth, save for retirement, save for your kids' college, save for that house, and then save for some other financial goal, short-term or long-term. So paying yourself first is a huge benefit when you're saving for retirement. And the concept just comes down to look at your disposable income, you know, what your current income is based versus your budget, and then go, okay, this is where I need to be for my emergency bucket. This is where I need to be for my short-term bucket, whether it be for a house, a wedding, a car, and then finally that percentage going towards wealth building. So this is kind of a way to think. Instead of going, well, I'm going to wait till I've built all the first 2 buckets up first, then save for retirement. This kind of puts you in a position where you're saving for all these goals, but you're putting more money towards those first buckets first, the emergency bucket and the short-term bucket. So you're paying yourself first. And so it all comes down to disposable income. If you have disposable income, the first thing you should do is build that emergency bucket, or at least in this case, apply a higher percentage of your savings towards that emergency bucket till it's full. And then once that's full, you move that money over to your short-term. Once that's full, you move that money over to your wealth building. But you want to come up with a dollar amount. So that's the first thing I want to talk about is, you know, this is, again, a very basic foundation, but it all goes back to having a game plan. Even if it's a basic game plan, a game plan means you're writing down and thinking about what is your income, what are your expenses, how much can you save, and how can you be prepared for the worst case scenario, but still plan for the best case scenario. Now, once you start building that 3rd bucket, how do you invest those dollars? How do you start building that wealth? One of the things I used to do is I used to sit down with employees at different employer firms and get them started in their 401k. A lot of folks will say, well, is a 401k better than just doing a Roth IRA separately? And I'd say, well, many times you can do a Roth contribution in your 401k. So that doesn't prohibit you from getting that match or that additional dollars from your employer when you're eligible for that. So that's a huge one. If you can save for retirement and get that additional dollar from your employer, that's one of the first things I tell clients to do, get the match and do as much as you can. But then the second, very next question is, well, then, okay, I'm putting into my retirement account or that Roth IRA or that other wealth building account. How do I invest those dollars? So there's many vehicles. 2 vehicles I like to talk about is mutual funds and ETFs. Mutual funds basically allow you to buy individual funds that own many, many stocks, on average about 150 stocks per fund. Now, be aware that each fund is going to invest differently. You have your long-term investments, meaning bigger companies, and you have your bonds, which are not stocks, but they're just basically debt from those companies. But then you have different styles of stocks, and we'll talk about that in a second. But just to give you an idea, you have consumer funds, entertainment stocks or entertainment funds that invest in entertainment stocks, pharmaceuticals, technology, consumer goods, telecommunications. And here are some of the names you see. And clients will say, well, what if, you know, one of these companies goes belly up and I lose my money? Well, in investing in either ETFs, mutual funds, or investments similar to these, you're buying a large scale percentage of many, many companies at once versus just buying an individual stock. Now, a lot of times I'll tell clients, or especially younger clients, hey, can't you just give me information about how to buy individual stocks? I want to just triple my money. I want to do the best I can. But what they're doing is they're looking at return versus looking at a foundation of planning for their actual financial goals. So in other words, their focus is just on return and not on going, am I saving enough am I getting the right type of return for my time frame and risk level to reach my financial goal? So those are things we'll talk about as we go forward. So here are some concepts of different types of mutual funds. We'll get a little bit more technical about them in a second. But you have your growth funds, your balanced fund, and income funds. A growth fund is basically going to be, again, those company stocks we just talked about. An income fund is going to be more debt, municipal debt or corporate debt. And then a balanced fund will be a combination of those two. The idea would be, as you get closer to a goal, let's say for retirement, you want to be less risky, so you'll have less in stock funds or growth funds and more in bond funds or balanced funds. Here's an idea of what I'm talking about. You can see the risk reward pyramid. Cash is at the bottom, bonds in the middle, stocks at the top. More risk, but a higher potential for return over time. So what that means is your risk will allow you to get higher return, but you'll see more ups and downs in the market, similar to what we're going to now. Interestingly enough, this time period in the market, bonds and stocks have both been dipping because interest rates are rising because of the high inflation we're dealing with. So this is a situation where we see both going down, but the one account you wouldn't see going down would be cash. But cash, again, even though rates are going up, is still paying very little interest as compared to bonds and or stock dividends. But stocks still would be considered more risky, as you'll see if you looked at a stock portfolio versus a bond portfolio. Even in this market, the stock portfolio would have gone down a bigger percentage in the bonds. But over time, stocks pay more, and they will grow at a higher pace. While bonds will kind of even out about 4%, stocks will be somewhere around 6 to 8% on average over the last 10 to 15 years or more. But if you look at the last 10, 15 years, it's a little skewed in the positive direction. The bigger time period you look at, the closer it comes to that 6 or 7% or 8%. So another concept would be also asset allocation. So when you start looking at this long-term goals and these long-term plans, and you're trying to figure out how to invest these additional dollars you've built up, now that you have these other buckets filled, you want to look at, well, how do I invest these dollars? A lot of times I'll tell clients, go see a professional, go see an advisor, a certified financial planner, an investment broker, an insurance agent, someone who has the expertise to help you pick your investment allocation for your time period. And they will help you choose what's the right percentage for your time frame. How much should I have in large cap versus mid cap versus small cap? Now, the concept here is mid cap and small cap, again, without getting into it too much. Mid cap and small cap are basically smaller companies. Large cap companies are much larger companies. They have much more shares and they have a bigger capitalization in the market. That's a basic explanation. But long story short, mid and small cap are riskier. Large cap would be like blue chip stocks, IBM, Apple. There's still risk inherent there, but not as much risk as a small company you may never have heard of before. So let's talk about systematic investing. So once you start building wealth, how do you do that? We talked about the 401k plan. And what's great about that kind of plan is that you can dollar cost average in, meaning you're buying a little at a time. So here's an example of investor A, investor B. Investor A is buying in a rising market. Investor B is buying in a fluctuating market, meaning the market's going up and down. In this case, it went down to 4% and then it went back up. In 4 months it went down and in 2 months it went back up. And you can see here in A versus B, by dollar cost averaging, you're reducing your average cost per share. Now, again, this isn't guaranteed performance, but it's a smarter way to invest rather than trying to time the market. You're doing it little by little, inch by inch, and this way you're kind of avoiding bad market timing, and you're also reducing your cost per share. The other step two would be, once you start building that wealth, now start paying down some debt. If you're in a debt position, not everyone's in that position, but one of the things that I run into as a financial planner is that a lot of folks want to save for tomorrow, but they're still carrying high debt. So if you're one of those individuals, here's one idea that could help you. Debt stacking would give you the option of actually you paying down your cards, but as you pay one card down, put the money you put for the first card onto the second card. You keep doing that till all your debts are paid, but instead of just putting that money in the bank, you start investing those dollars. Here's an example of someone did that, and they had about $2.4 million over the time frame that they would have just been paying that debt off and doing nothing else. So debt stacking is one way to reduce debt. It's psychological because you're already making the payment, but as you pay off a card, you pay off the smallest card first, then you put that extra payment towards the next card, so on and so forth, until you can then put that money towards investing. I'm running out of time, so I'm going to speed up these last two slides. So one idea, the third step would be, and another idea of investing, and you may run into this as you start talking to financial planners or advisors. Do you need insurance? And a lot of times, if you are in a position where you have children or you bought your first home and you're looking to buy some insurance against the worst case scenario, one strategy is to buy term and invest the difference. Meaning, instead of buying expensive whole life insurance at $225 a month, you would buy term insurance, get the same protection, but then invest the difference with that savings of about $145 per month in premiums per this example. And you can see this individual was able to turn that savings to $265,000 versus $76,000 if they had just used cash value life insurance. Now, again, a lot of times that's not as sexy, that's not exciting to talk about insurance when you're talking about just building wealth. But building wealth, you cannot not discuss protecting your assets and protecting your income, because if you don't have your income, you cannot build your wealth. Now, many of you have employers that have really good benefit packages, but it's always good to sit down with your HR individual and make sure if you were to become disabled, you can also protect that income. And one of the things we need to think about too, as we get older and our wealth builds, when we're younger, we're having young children, we may have high debt, we first have our mortgage. But as you get closer to retirement and you've been building these assets and your wealth has been growing, you want to change your plan at that point and start thinking about, I don't need as much protection. I need to just start creating a retirement income, meaning there's more bonds, more income funds, more dividends versus a growth portfolio and high insurance. You need less insurance and less risk in your portfolio. So what's the solution? Again, I mentioned before, seek a certified financial planner, certified public accountant, or other planning professional. And first things first, take an assessment of your current situation, review your long-term and short-term financial goals, come up with a plan, and then implement that plan with a professional, build that emergency account, eliminate unnecessary debt, protect your income, and follow that plan, and then adjust that plan over time. As life changes, you will need to adjust that plan. A lot of times brokers will tell their clients, just leave it alone, don't change anything, keep going what you're doing, which is not a bad advice in a down market. So you don't want to sell when the money is down, your investments are down, but it's never a good idea not to keep visiting with your planner, not to keep visiting with a professional, not to keep revisiting your plan and adjusting it as time goes forward, because everything changes. Your life changes, the market changes. You still want to make sure you're doing what's best for you financially. So that's the end of my presentation. I hope I didn't go too over time. I'm going to stop sharing. Give me a second. And I think somebody's muted.
Sorry about that. Can you guys hear me now?
Yes.
Excellent, excellent. Thank you, Ernest. You really came in hot today. You really covered it from soup to nuts, everything from budgeting down to insurance. You actually covered the whole life cycle, so I appreciate that. I'm very sure that folks are going to have questions following up on the 3 funds, right? Also putting your investment into autopilot. I really love that. I live and die by that, to be very honest. And also, I may have some questions also following up on insurance. So we'll catch you right after. All right.
Sounds good.
All right. Ryan, are you ready to rock? I think you're still on mute there.
Good afternoon, guys. I hope everyone's having a good day. So when it comes to investing, I look at it a little bit more on a simpler level, because after learning about investment for the last 20 years, I realized that it's very simple compared to the stigma that people have that investment is completely hard and it's a gambling game that's stuck against you. So primarily, when I think of investment, I'm thinking about how could my money work for me? I know that investment involves risk, and I know that it's not similar to a savings account or a high yield checking account, but it's more involved the risk and the life cycle of what I want to achieve and the time that I want to achieve it. It's like Ernest said before, if you're saving for the long term, and you're retiring, then I also recommend similarly that you invest in your 401k first. The first thing you want to do is you want to make sure that if your company has a 401k, you want to invest in it. There's 2 great benefits. One is that if your company matches, you can take advantage of the match, and your company might match up to 5 to 10% of whatever you're allocating to your retirement account, and that's like free money that you're receiving just for doing your part of allocating funds to your retirement account. Now, I get asked this question a lot of times from people who said, "Hey, my company don't offer a match. Should I still participate in their retirement account?" And my answer is always yes. And here's why. When you participate in a retirement account, you are participating in a deferred tax structured, right? So for example, if you're a high income earner and you don't put money into a 401k, you're going to pay more taxes on the money you earn. But if you contribute that money into a 401k, it reduces your taxable income and you pay less taxes. So it's a win-win for you. So even if your employer is not matching, it's still a good idea to still contribute with your employer and take advantage of the tax benefit that's associated with it. Investment goes by the risk level. So when I meet with my clients, friends and peers, I always talk about the goal setting idea of what it is to invest. So the first thing that we always do is we think about what are our short-term, long-term, and our immediate goals. The most important goal that is essential to invest in is paying off debt. People always ask me, how could I save or make more money? And my first response is pay off your debt. If you're carrying debt, right, you're more or less like carrying this debt at double-digit interest rate on your debt. So it makes almost no sense to put that money into the stock market, which promises about 8 to 12% return, and your interest rate on your credit card or on a loan is 16+%. So the first thing we do, which is immediate, is to make sure that we minimize our debt exposure. So we stop spending when necessary, and we try to, come up with an action plan to pay off the current debt that we have, because we know that once we free up that money from paying off these debt, we can now invest it in the stock market and take advantage of dollar averaging and make money in the long term. Our middle to short term goals would be building out an emergency fund. In the past, it was 6 months. I think I recommend anywhere from 1 month to 15 months, because it takes people sometimes a longer time to find jobs in this economic climate, as well as like you're not sure if you would be hurt or injured. And if that's the case, it may take you some time to heal. So if you can't work, you want to make sure you have a good amount of emergency funds set aside so you can pay your bills and take care of your family. For me, investment in the stock market is a little different than what I learned when I first started investing. So when I first started investing, I was following the books. I was, listening to financial advisors, CPAs, CFAs, investment brokers, everyone who pretty much had a lot more experience and knowledge than I did. But over time, I found that the best thing that worked for me was the simplicity of investing. And I came up with the whole idea that if you invest in what you consume in, if it's a good company, then it's a win-win for you. So for example, I started investing when I was like 18 years old, and I've been primarily buying companies over the long term that I particularly like, just based on the fact that I spend my money with these companies. For example, like I own Apple, AT&T, Coca-Cola, and so forth. But that's how simple it is to invest. When people always ask me, what stocks do I buy? Where do I start? I always tell them, look around your home, see what you're spending your money on. If you're spending thousands of dollars a year on different products, household products or consumer products in your home, it might be a good chance to research a company, check out if they're a good company, check out their history. And if they're a good company, you might want to buy them. So I try to make it easy for people to just see that you don't have to think about, okay, well, I'm going to buy stock A versus stock B, but you could buy something that you already are passionate about, whether you're consuming it, and then you can buy from it. But most people don't want to buy individual stocks because, as mentioned before, individual stocks are more risky than buying like an ETF, index fund, or a mutual fund. So if you are one of those individuals who are on the fence, you don't want to buy one stock because you're afraid that if you wake up tomorrow morning, the stock price might drop completely to zero, or you might lose all your money, you can buy a fund, which would be a mutual fund, an exchange traded fund, or index fund, which primarily you can pick a sector. So there's different sectors you can pick, like you could pick growth stocks, tech, consumer goods, you can pick oil. So there's different sectors you can buy into based on trends that are currently happening. So right now the market is not doing well if you guys are following, but if you notice, oil is doing really good. So if you invest in an all FT ETF, or an oil company, you may have seen some green days in the last couple of days, or consistent green days, whereas the rest of the market have been consistently dropping and reshuffling itself each day or each week. So another thing that I touched on in investing is, when you're investing, you wanna think about what's currently happening in the market. So as of right now, we're going through a correction, which people think is a correction. Some people think we're actually in a bear market. Some people think we're in a recession. But what's happening is that inflation is increasing, and once inflation is increasing, interest rates increases, and that usually makes it unattractive for people who are borrowing against from the bank to invest in their business, whether it's to invest in research and development, or to create new products or new supplies, or even to combat the high cost to buy supplies because of inflation. So if the market has inflation, then you expect to see some downward days in the market. But if the market doesn't have inflation, then you might see some neutral days, or even some uptrends, right? Also, you might see some accumulation of debt by companies that you look into. So companies are probably going to be reporting mixed guidance, because they're now going to have more debt because of inflation. But primarily, when you're investing, you're looking at everything at a larger scale. So you're looking to see what works for you and what doesn't work for you. So I always tell people, if you're a short-term investor, you have less time. So whatever you're buying, whatever you are invested in, whether it's stocks, bonds, or even if you're investing in alternative investments such as like crowdfunding or real estate investment trust, you can minimize your risk exposure based on the time you have. So if you have less time, there's not a lot of time you can actually use to offset a downtrend in the market. But if you have like 20 years, you can pretty much ride it out, and the benefit of it is dollar averaging, which means you're buying the same stock or the same ETFs at a variety of time throughout the year. It might be weekly, bi-weekly, monthly, but what you're doing is you're buying on highs and lows. Overall, you're averaging in the middle, which is the medium, and you're primarily going to stay in a good position so that when the market increases in a couple of years, you could benefit and take your money out, or you can wait even longer, because it resets itself almost every 10 years, with what I've seen in the last 20 years of trends. Looking back at the stock market over the last 20 years, because it's essential to look at the past to get to the present. Most of you may have noticed in 2020, during the pandemic infancy stage, the market did a small crash, with the prices dropped significantly, and we're kind of experiencing that same cycle again today. So I always try to tell people, like, don't have the fear of just getting out because it's not going in your favor. The market is kind of repetitive in the sense that what happens 10 years ago may happen again this year. And looking for trends, if you're a trader, you'll notice that the trends kind of help you predict what's going to happen. But if you're a long-term investor, you're just looking to buy on, at a lower price for a good company and hold it for a long period of time, and the reward will be in the future. So again, you could buy individual stocks or bonds, which is relatively easy to do. Today you can start investing on a robot app, which like Robinhood, Webull, for a fraction of what you would have had to do, let's say 15 years ago. When I first started investing, you had to buy whole shares. Today you can buy fraction shares. So anyone can invest as little as $1 or even $5 on some platforms and compound that over time, and you can build wealth. Because the whole idea of this presentation is about building wealth. So it's not about starting off with $1 billion today, but it's about starting off with as little as you can, being consistent over time, utilizing dollar averaging. You might want to utilize some dollar averaging with some dividend stocks and increase your shares over time, which means you're building wealth in the background with the time that you have allotted for the future. Where to invest is a question I get a lot from people, and why. So the 3 reasons people mostly invest is for general purposes. They're looking to buy a home. They're looking to perhaps have a large amount of money for a vacation or something special or general to the need of their family and themselves. Or they might be investing for their child's college tuition in the future, or retirement. So based on those 3 parameters of what you want to invest in, you can associate a specific time with it. So general purposes might be a shorter term goal, whereas college might be 18 years if you have a newborn, or maybe 5 years if you have a 13-year-old. But retirement, for the most part, is long term. So in building wealth, we want to touch on all three brackets, especially if you have a family. You want to make sure that you are saving enough money and allocating funds to retirement. Most people who I speak to in the last have asked me the importance of saving versus investing. And my answer, which is my personal answer, it depends on you. It depends on you and your goal. I think you can do both. One, again, is more secure. If you're saving in a savings account, you have lower return on your investment, but at minimum, your money is, whatever you put in there is going to be there. If you're investing in the stock market, you have a little risk depending on what you buy. Given what we're experiencing in the last couple of months, your money may be lower than it was initially, but the beauty of investing in the stock market is that if you don't sell anything that you own, you don't have a loss. So most people often call me on red days and they want to sell everything, not tell them don't sell anything unless it's something that is potentially worthless. You want to keep it because you don't have a loss until you sell your asset. So it's a unrecognizable loss when you have a loss in your portfolio. But if you sell it, then it's realized, and then you potentially lost a value of something that you previously had. Where do I plan to invest my money, or where do I see myself investing money? It's a question that I get a lot from people, and most people, they're investing their money pretty much in growth stocks or tech stocks. Ernest touched upon it a little earlier, where growth stocks primarily, these are the stocks that you could potentially buy today and something miraculously happen and the price goes up significantly. Now that's more of a gamble than buying a stock that has, a great balance sheet, has cash reserve, has strong cash flow, has a solid EBITDA, and all the other financial indicators that allow us to see that a company is good. Is there. But if you're gambling, then it becomes a little bit difficult for you to invest. But the three pillars before I wrap up for investments, I think, is first, learning the basics and coming up with an action plan. Write a plan down. I think it's always good to write things down. Have a plan that works for you, not based on what you see on social media or a friend. Two, work with what you have. So if you have debt, budget, create a new budget that's working, so you pay on your debt and you can start saving. Once you start saving, you can start planning different buckets on how you can invest. So perhaps you may save $200 from paying down debt. You probably can allocate $100 to savings, $100 to invest in stock market, depending on your risk level. Once you get the hang of it, just continue it. The last goal is continue it. Always be consistent. Always be able to rinse and repeat. So that's the way that I've done successfully in the market, is by buying and doing the same thing that I've been doing since I was 18 over and over again. I just turned 38, and I tell you, I kid you guys not, nothing that I've done for the last 20 years I regret, because I've just been taking my time and patience doing the things that I've been learning in the market, as well as getting advice from professionals. And that's it for me.
Wow, gosh. Ryan, thank you. My pen is on fire. I appreciate both of you guys. We do have a couple questions here. Before we go into the Q&A, Ryan, I love what you said about contributing to the retirement account. Even though there isn't matching, I learned that a little bit too late in life. Right? Definitely, we learned the taxes. We learned the lesson about taxes when we start to bring it in. So, I also love what you mentioned about buying what you're passionate about. That's pretty important. Also, some people are in some very interesting fields. Mm-hmm. So, I have a lot of friends that are doctors, and, they told me about, let's say, ISRG. I had no idea what that is. I had no idea about the Da Vinci machine, but, they really clued me into it at the time. Also, I like what you said, paying attention to what's going on, right? Being clued in on the news, right? Although inflation is very hard to miss, I'm quite sure for all of us right now. Yeah. And lastly, I really love what you said about fractional shares. I remember when I was investing early, a young, probably 15, 16, and I could not afford, you know, the SPY or the VTI or VO. I could not afford anything.
Yeah.
But I would buy the smallest, you know, fraction of a share, and it would add up. It would add up, and before you knew it, you know, little old Dennis had, you know, accumulated a share, right? So
Yes.
definitely great things there. So let's jump into the Q&A. Guys, feel free to post your questions in the Q&A. Let's go with Nick. I believe Nick is asking about the, Ernest, this looks like it's referring to your earlier presentation. I believe Nick is asking about the risk-reward ratio for mutual funds in comparison to ETFs. He's saying that some companies have higher risk but provide higher rewards, but mutual funds are relatively safe, but also the rewards are lower. Are you able to see the question?
Yeah, I think that's kind of the same way I took the question as well.
Yeah, yeah.
It's a little, coming from the background of working with investments for a long time, it's kind of threw me off a little bit because it's kind of, we're kind of saying the same thing, but we're not. So mutual funds, whether it's mutual funds or ETFs, the risk reward ratio always depends on the type of investments that ETF or mutual fund is investing in. So if you have a high tech, very risky industry, small cap mutual fund, it's going to be very high risk, high probability of big fluctuations. But if it has a good year, it could be a really high return. So I think we're saying the same thing, but so the more risk you take, the more reward. But what you want to do when creating an asset allocation portfolio, it's all about looking at probability, you know, so it's everything goes up or down over time, right? So whether it's industries like the tech stocks or industries of just big company stocks that are riskier than, for example, bond funds or ETF positions, when you look at the market over time, probability says you're going to have more fluctuations the higher the risk you take, even though the reward's bigger. So what that means is that the probability of you getting that reward depends highly on you timing it and getting in and out at the right time. So asset allocation allows you basically to invest, and you can still kind of find that balance. They call it the market efficiency frontier. You want to balance the reward with return, but reduce the probability of those big swings as much as possible. Now, of course, the more sophisticated you are, the more research you do, the more time you spend researching a stock you feel good about. You could say, well, what if I just bought an individual stock? Is it possible that I can have a really good reward and still feel confident about what I'm doing? Again, it goes back to your time and energy and skill set and background and some luck, you know, some luck, because no matter how good you are, how smart you are, or how much time you research something, I like to say you don't know what you don't know. And for example, there's many, like I think of MCI WorldCom or Enron, those types of companies where professional CPAs like myself said, signed off on what they were doing, and it said this is perfect, and it was perfectly legal at the time, but obviously it was still unethical, right? Because so we don't know what we don't know. So it depends on your risk tolerance and your time frame. But does that mean I'm going to go, well, if the risk is higher, but that means the biggest reward, I'm going to go with the most risk possible and just get the biggest reward I can. I said, well, that's great if you have lots of time and your risk tolerance is very high, meaning you won't faint when you see the market go the other way or jump out the window. Then go ahead and do that. You know, but again, I like to think of saving and building wealth. The term or the idea of building wealth is why take unnecessary extra risk you don't have to take if the goal is to beat the relative opposite, meaning what's the other option? What are the other opportunity costs? If the opportunity is I'm going to get 1% at the bank, or I can get 6% in the market and keep my fluctuations as down as possible, I'd rather get 6%. So what I'm trying to do is get people not to think about return only. You know, you got to think about what am I doing? Does it make sense? And what's the probability of success? And how much risk do I want to apply to that goal? So, you know, it's a different mindset. Now, having said that, I have my own small risky portfolio, and I've done that in the past myself, where I go after those big, you know, bigger returns. But that should be with your additional excess beyond your goal. You're hitting your goals, you're doing well, you're making all your financial independent streams possible, and now you have still excess dollars, then, and you have the time, the energy, and you feel passionate about doing it, then go ahead and do it. That's probably a long-winded answer to that question, but I felt I had to kind of make sure I covered everything because it was a very generic question. You know, I'm trying to read his mind, but I may not be getting the right spot. You know, Ryan, if you want to give it a shot.
I think you summed it up pretty good. I do agree that what you're saying, that it depends on, you know, the timing as well as it depends on your knowledge. I think one thing that I would add is that what I'm similar to Ernest, I have about 4 portfolios, right? I have one that I know is my long-term portfolio. I'm just building my wealth until I retire. Then I have some small ones that they're a little bit more risky, that I'm chasing some, you know, some profitability there. But those portfolios that I have that are not my long-term, if I was to lose that money, I would be fine because it's extra money outside of everything else that I've already allocated. So if your allocation isn't there, you don't want to play with your future. So you don't want to gamble your money away, because that's primarily what you're doing, is gambling when you're taking on more risk than you can handle. Because at the end of the day, is you never know when you wake up one morning and the market is down, and you either lose everything or you lose a lot and have to wait now 4 or 5 years to recover it.
True. What do you guys, and before I jump into the next question, I love that specific part about having, you know, if you build up enough portfolio, retirement portfolio, hey, why not have a risky portfolio? I really like that, yeah. Or a risky side portfolio, so to speak. The next question, what is considered a high income when it comes to taxes? That is, it's sort of wide, but you guys can take a shot.
For me, it depends on what you're doing. So I don't think any income is high if you're paying the right amount of taxes. The biggest misconception that I've seen with people who, especially people who start out working, they don't fill out the W-4s correctly when they have multiple jobs. So if you have one job and you're a high income earner, it's straightforward. You'll pay the taxes according to your dependents and stuff like that. But if you don't fill that information out correctly or truthfully, then the high income doesn't really matter. You're still gonna owe. So I think high income for me is anything above, I would say about 80,000, because that's when you start seeing a real shift in the tax bracket. So about 80, you see it start going to about 20%.
I would agree with that as well. That's perfect.
All right. The next question. I believe this was about investing into individual stocks, individual companies. Anonymous question, which is perfectly fine. You know, I post so many anonymous questions here and there. So, what happens when you're, you know, they're basically talking about the risk of what happens when you buy into this company, surefire thing. It's supposed to go to the moon, so to speak. And what happens when you're forced to sell at zero, which means you're at a full loss? How do you guys mitigate that risk? Or do you not care because it's your first year portfolio?
Yeah, in my case, that would be back to risk. That would be a riskier portfolio. If I did my due diligence, I have the financials, I looked at the history, I looked at the CEO, I looked at their past performance, their future performance, and I still messed up and somehow the company goes belly up. I hopefully didn't put all my eggs in that basket. You know, I didn't put all my funds in there. That's money that I could risk, and if it goes under, hey, the next one probably will hit the ball out of the park. So it's all part of that risk reward. But you should never put all your eggs in one basket. Even in the aggressive portfolio, you should even then you should have maybe 4 or 5 companies, maybe more. But the thing is, the time it takes to do real research on a company, to really look at their financials, really read it and go through it, especially if you have a background in accounting. You know, what goes into a financial statement, there's a lot of pieces to the puzzle once you start really breaking down a financial statement and looking at all the ratios. But yeah, it would just be a matter of take your loss, take the deduction on your tax return. Whatever you're unable to deduct, you can carry forward for future gains. So that is always still something you could write off on your taxes, but you just have to accept some losses sometimes. You know, but what does it say? Every time you get knocked down, just get back up again. Don't give up. So that's basically that's my motto.
Next question. The I bonds, Series I. I'm sure you guys have heard about this. I believe it's what, 7-8% in under a year. Are they a better move right now? And when are bonds a better move than stocks? Either you can take it.
I'll take that one. I think for me personally, I think you know, I don't ever want to chase a return, especially on a bond, because the bond market is very volatile. It could go south really quick, or it could go north really quick, right? But it's very stable. It's like almost guaranteed, with the interest, right? That's what people think in their mind when they invest in bonds. I think usually the bonds and stock usually operate opposite. So when the bond market is up, the stock market is down. But what we're seeing right now is that both of them are down. So there's no like Ernest was saying, you have to do your probability to see what is the likelihood of that bond being strong in the past and to predict the future. So you can't just go based on what it is today. It requires some research of the past to see if you can kind of pinpoint if it will repeat a cycle or it will continue to be consistently good over time.
All right. The next, and I'm sure you guys knew that you were going to get these questions. Crypto. What about the more risky but more rewarding investing, such as crypto, albeit a small part of one's investment portfolio? Is it even worth considering? Any of you gentlemen can jump in.
I'll take this one. I have not had a lot of experience with crypto. I work with a lot of professionals who say as a piece of the portfolio, similar to gold positions and things like that, that would be something to have as a piece of your portfolio. Having said that, I know there are some investment brokers and investors are really excited about crypto and they think it's a good way to either find a new way to meet their goals, their financial goals. But for me personally, I tend to swing conservatively. I'm still not 100% bought into the whole crypto mentality, and I may be showing my age, but that could just be something where I'm saying, okay, again, a small piece of the portfolio, do some research, buy the one that has the most history, the most more stability, and then go from there. But just beware. This shouldn't be part of your bigger long-term goals. It should be more of your short-term, see what you can do. Now, if you become an expert and you do really well and you feel you build that confidence, then, maybe increase your percentage in that type of investment. I just a side note, I was talking to one of the partners here today and he could not say anything good about crypto. And this guy is, I would say he's almost, very, very smart guy, one at the firm, one of the longer term partners here. And they don't do investments here at my firm. They do kind of the long-term tax planning. And I do basic financial planning. I don't do direct investments. I don't actually recommend investments. But I work with individuals in making sure they're planning for the future. And then I refer them to an investment broker. But in that case, even the brokers I'm talking to, their comfort level is, yes, we'll deal with it, we'll get involved in it, we'll help our clients with it, but it's not their bread and butter so far. I mean, I'm in upstate New York, so it may be a different world altogether. Having said that, I do have some young employees here that probably could give me a lesson in crypto for a couple of hours because they're excited about it. It's different. They're all about it. They've done all the research. But I would just say, just to sign off on this one, do your research, really make sure you know what you're doing, pick the right ones. But again, this should be more of not your main goal. It should be, hey, I'm trying to hit a home run. I'm trying to make some return. I wouldn't put my retirement in that type of investment just yet.
So let's add to it. Nick posted a question, sort of a follow-up. Do you think it's sort of age related? Like maybe the age and the risk exposure regarding crypto?
I believe so. I've been doing crypto since 2015. So I was one of the people who got in early and kind of tried to figure it out. To be honest, I've been doing crypto for so many years, and to my best research and knowledge, only a handful of stocks have utilization, which means they could be used for something else. So what the problem with crypto is that anyone can create a coin. And because anyone can create a coin anywhere, you have these pump and dump schemes where people are saying, oh, this coin's going to the moon. And young investors who are more into reward, they're buying these coins that which potentially not going to do anything with it, right? So for me, I was successful in the sense that I got on board early, and I kind of focused on the ones that had utilization. So I got into Bitcoin and Ethereum and Litecoin, and what's it called? Dash coin and some other coins that I kept for a very long time, and I kind of forgot about them. And then when they became popular again in like 2019, I got back in on board, and I was surprised that I had bought Dogecoin at like a very, very small amount of money, and it was worth a lot when I sold it last year, right? But it's a gamble. It's a risk. It's not developed yet. It's in its infancy stage. There's a lot more for crypto, primarily regulations that aren't really solidified. So because the regulation hasn't been solidified by the federal government, crypto is very risky. So we kind of saw Lunar drop from $150 to 0.00001, and people are like, oh, that was going to the moon. It went to the moon, but because we're greedy, we didn't sell. So it dropped and we lost the moon. So it's very, very risky, but you have to do your due diligence. You can't just rely on it. And as Ernest said, this should not be part of your retirement for long term, but with the extra money you have, you can put into that on the side.
So it's not Lamborghini money. It's not.
No.
Right? So let's shift into student loan debt. This is a question I often hear about, right? How do you recommend balancing the student loan debt? And there's so many answers on this, right? But how do you recommend balancing the student loan debt as well as the investing, right? Both are important. Don't want to get Uncle Sam mad or your creditors mad, and you still want to build wealth. Do you recommend debt stacking? Was another part of it.
I think for me, student loan, what I tell people and I tell myself is that it depends on what interest rate your student loan is carrying, right? So if your student loan is carrying like 6% interest rate, and you're going to invest in the stock market and probably make 3 or 4% if you're in a rush, but if you have long term, you're making about 8 to 12%. It makes sense to me to pay down student loan debt also, but it depends on your income level, because you get to deduct your interest that you pay if your income is below, I believe it's 85,000. Once it goes to 85,000, it begins to phase out. So like I believe 105, and then completely after, if you're a high income earner, there's no benefit of paying student loan just to pay the interest to get it written off, because you can't write it off for tax purposes. So it all depends on those different things that will allow me to tell someone how to kind of navigate between, maybe you have a higher percentage going towards your student loan and a small percentage going into retirement and investment, if you must do both. But primarily it's a debt still, and people always say it's a good debt, but to me it's still a debt that if you are a high income earner, it has no benefit to you.
Yeah, over a certain income limit, you lose the deduction.
Yeah.
So that's something you want to consider. If you're not getting the deduction on your tax return year to year, and it's a very high interest rate, then yes, pay it off as fast as possible, as soon as possible. If you are getting a deduction, it's a low interest rate, and you work out the math, and it's, you have you rather say, well, should I invest it? Then maybe in that case, it may make sense. But just remember that debt, if you don't, the sooner you get rid of it, the more you can put towards investing altogether. So in my mind, it's still better to pay it off. But if you can take the deduction and the interest rate is low and you've stretched it out over 10 years, long-term total interest paid is still not better than just paying it off. But then you have to weigh out, well, what if I invested that money instead of paying it off? Would I beat the rate with the deduction? Sometimes you do win. You do win if you do like an Excel and you kind of do planning and you look at, if I'm at a low interest rate and it is deductible currently on my tax return, because it's an above the line deduction, you don't need to worry about itemizing, so that always is a good thing. But if your AGI is too high, like Ryan was saying, you lose the deduction. So if your AGI is low enough, the interest rate is low enough, and you feel you're confident enough to do the difference in the market, you may beat out the difference. So one strategy I thought of in the past would be, if you're in a position where you can get the deduction, maybe instead of paying it off, put that money in a Roth IRA. Over time, you can take that Roth IRA and then pay off that student loan down the line. Hopefully, you're not still carrying student loan debt by the time you're able to use a Roth IRA, but
Yes,
you know, just some things to consider. You know, but that's the difference. So it kind of like the part of me is like, no debt, get rid of all debt, and then part of me is like, well, you can invest the difference and put it in a Roth IRA. It'll still have more worth down the line. So nothing is cookie cutter. That's why I say it's always good to sit down, crunch the numbers, and see what makes sense to you.
All right. I think I have one more question. Actually, I have time for one more question. That is actually two questions I'm merging into one. So you guys might have to be patient with me here. So with the advent of these new apps and you know, very flashy and easy to use discount brokers, their apps and fun interfaces, do you think it's better to one, does it affect how you invest, right? Either via, you know, a professional, a CPA or tax accountant, or and then two, does it also, does it also encourage you to maybe refer people to robo-investing?
I'll
let Ryan answer that one first.
Okay. So for robo investment, I think it's a great starter. For my long-term investment, I use E-Trade. I've been using E-Trade for a very, very long time. I think the more established brokerage, I like them more because they have more resources available for you. They were the foundation of my investment journey. So I kind of feel like despite, you know, I had to pay fees in the past to access certain stuff, it kind of made me want to be taken more seriously. I think when something is free, we tend to take advantage of it and we misuse it, right? Now, I think Robinhood and Webull, they're great tools, they're great apps, but I think you have to look at the company overall history. And I'm uncertain about Robinhood just because of the politics behind the company operations. And I don't know if my money is really secure there. You know, we have the FDIC rule, of course, 250 is going to be secure, but still, you don't want to have to go through any hardship of getting your money back. So I prefer that if you would want to start, you definitely look at one of the most established brokers like the E-Trade or TD Ameritrade. They do everything that Robinhood does. They do options. They do everything that people think Robinhood only do. And they also have no or low fees too as well.
Yes. Ernest?
I would agree with that. The only thing I would add is that, or a couple things I would add is anything that gets people excited, and the younger generation, they're excited about apps, they're excited, it makes them excited about investing. Part of me is like, you know, good luck, you know, but the other part of me is like, at least they're thinking, they're looking, they're learning, they're experiencing risk and reward, and, you know, they're taking being active in their own destiny. So I think that's a good thing. For the majority of the folks I've worked with in the past, investing, there's a psychological component, not just to saving, but how to stay and not move at the wrong time and let fear drive you. And so sometimes people say, well, I don't want to pay a broker, I don't want to pay a CPA, I don't want to pay a CFP, I don't want to have high fees. And I think what you want to do is shop around for the lowest fees you can. But the majority of the folks I've worked with in the past, the majority of the people I run into, the majority of the public benefits from working with a professional. And I'll tell you why, because it's just having two heads are better than one, that old philosophy. And when you can work together and you can talk about it and you can say, what about this? You thought about that? And you can, you know, feed off each other and kind of come up with a game plan and adapt that game plan over time. Having that professional, and just psychologically, people, I've seen it work more often than not. When someone does their own plan on their own, unless they have that personality, which is not the majority, that's the exception. I've seen people always do better when working either for two things: their 401k plan and or a broker, because a broker is going to say, don't sell, no, don't sell, it's not the right time. And the 401k plan always works better because out of sight, out of mind.
Yes.
It's a systematic, you're not thinking about it. And so it does what it needs to do without you monkeying up the gears, so to say.
Exactly.
So that's where I think both things are good. But I wouldn't necessarily go, oh, using a broker and paying high fees is never a good idea. If a broker can show you the value and it's worth the money to you and you feel the benefit, pay that broker and be happy that you're getting that service. If you want to do it yourself and you're motivated and passionate and you want to do the research and educate yourself, then go that route as well. There is no perfect answer for anybody, but just do something. is what I would say.
So guys, I unfortunately we're up on time. I have a long list of questions to even ask you, Ryan, to ask you, Ernest. So what I'll be doing is I'll be following up. We did post their contact information in the chat, so make sure you guys capture that. What is wow, we're out on time. Goodness. What's this one thing, real quick? One thing that you want everybody to take away right now? You know, going into investing, like just one thing they can hold on to. Ryan, Ernest.
I'll let Ryan go first.
I would say do your due diligence by doing your research and have patience with yourself.
I like it. I like it. Ernest?
This is kind of corny, but I always tell clients, I've always say this all the time, plan for the best, but be prepared for the worst. If you do that, then you're going to be better off than, again, doing nothing.
All right. Beautiful. Gentlemen, thank you. Thank you for joining us. Our Binghamton community, thank you. Thank you so much for, joining us, giving us your afternoon and gaining so much. Please follow up with these gentlemen. I know I will.